Okay. The last class we had we stopped on balance sheet, so we'll take it up from here. Remember, this is not to teach you accounts or like professional accountants. Um, it's for you to have understanding of how all these things are done, what is in it. Then from there, when the accounts are prepared, you will naturally flow with it. And decisions are made. You can answer questions. When they're interpreting it, or you are interpreting it, you understand how things are done and all that. That's the essence of this. For those who are deep into finance, beautiful. You can handle this from different angle, deeper part of it and other keeping the book. But those of us who are not deep into finance, beautiful also, you understand what they're discussing and know where the numbers are going and how to trace your numbers as well. So that's the essence of these sections, this master class. Okay, so looking at balance sheet, that's statement of a financial report. That's the current name. Now, a balance sheet is a financial statement that shows what a business is worth at a specific point in time. Yes, what is the worth of your business at a specific point in time? That's what balance sheet tells us. And then, if you look at it critically, that means there's a what. I mean, like a business can be said, this business is 10,000, business is 12,000, is 1 million. So at every point in time, do you know the worth of your business? That's a simple reality. Most people don't even know the worth of their business. In fact, the other one is even far. Most people that are into business, especially those that are into trading, you buy goods and all that, they don't even know the inventory. You don't know what they have in their shop. And that leads us to this thing you used to hear. You have people working with you, you have your sales, people, your the those are doing Eba boy for you, and you see the person doing the Eba boy, millions in his or her accounts. Why? The owner of the business does not know exactly the worth of that business. They don't do inventory. They don't take stock. Yes. All they know is that they come and look at the shop, their goods are plenty, and they keep buying. And money is in their account. Simple. They don't sit down to take stock. Most ogas don't do that. So they just trust. Once they have 1, 2, 3, 4, 5 boys, they will move on. They will move on. But if you sit down to take stock, and if God didn't help you, you have a bad boy. The boy will be making money for you. Yes, they'll be making money. I mean, you will not really notice it, but these boys will be making so much for themselves. Because of what? There are so much of loopholes in the system. We'll still come to this when we start dealing cash flow. So the statement of financial position tells you the worth of the organization. Very, very important. Now, if you look at what we have, it says it at times, its primary purpose is to show assets, liability, and equity. Yeah, these are the big words. Equity in bracket capital, rather than what financial results. These are the big words. So, but when a cash flow shows us one of the financial results, P&L shows us one of the financial results. You see how they are differentiated. Now, but does your assets, liability, equity to capital are what translates to your financial results. I will break it down. When we do cash flow, you understand it more. But that's where everything started from cash flow. Everything starts from cash flow. Yes. See how balance sheet works. The balance sheet essentially shows what the company owns, what it owes, and how much is invested in it. Underline these three things. What belongs to the company, what the company is using that belongs to other people, and how much have been invested in the company. I'll repeat it. The book of financial position shows you what belongs to the company, what the company is using that doesn't belong to them, then how much have been invested in the company. Always know these three things. Assuming there is nothing else you've learned about statement of financial position, which is balance sheet, know these three things. That's what is balance sheet. What am I owing? What is my own in this thing? In this company I'm running, in this business, what is my own? What have I borrowed from other people that is not my own, that I must give them back? And what have I invested in this company? These three things are very, very crucial. Now, it is based on the accounting formula, sometimes called the balance sheet equation, which is the basis of double entry bookkeeping. This shows the relationship between assets, which is what you're owing, what your company, what belongs to you. Liability, what you owe, what you've gotten from other people that you need to give back to them. Or what you've gotten that what you're using that you need to give, or you need to give back. Then how much I've been invested in the business, what's called the business capital. I'm using the simplest layman language. What the company owns is assets. It means that he was able to purchase it either through debt or investment. Do you understand it? What do you mean by through debt? Debt simply means you got an asset that you are owing the people. That is debt in a simple way. They say you bought a car for your company and that car is 10 million and you paid only 1 million, remaining 9 million. So you're owing the other people 9 million. So you collected something from them and you need to return back. And now you're not returning back the car, you're returning back their money. That's liability. Remember I said balance sheet takes us three major things. What is your own? What you borrowed from other people, that's what, and how much you've invested. So this asset can be gotten through borrowing from people, that's liability, creating debt, or through investment, that is using the capital. Do you understand it? So when you hear the word liability plus investment or capital equal to assets, so the equation always balances, as everything a company owns has to have been bought with the business funds or through borrowing. So this will always balance each other. So there's no magic in balance sheets. It's very simple. Very, very simple. Now, the balance sheet equation, as the name suggests, the balance sheets must always balance. This is because everything in the business owns what you own, your own. Each asset must be offset against the equivalent capital, in bracket equity, and liability, debt. So it's either you use what you've invested, the capital, to buy the asset, or you borrowed it. So put your capital and your borrow your liability is equal to your asset. So company has no liability. For example, a young business may have asset of $1,000. It currently has no liability. So its capital is equal to what? It's an asset. That is it. Let me break it down. You have a, let's say, this list of the list. Let's say you're into fashion designing. You're able to raise 100,000 naira, or let's call it 1 million, and use that 1 million to buy your machines. At that point in time, there is no liability. It's your own. Your capital of 1 million, you simply transfer it into what? A machine of what? 1 million. Or let's say you bought a machine for 800,000. So you have capital of 1 million, machine of 800,000. So there's a difference of what? 200,000. Automatically, for it to balance, you have what? Cash, which is also an asset. Cash of what? 200. So in your knowing the worth of the company, you look at the capital invested, 1 million naira. Where did the capital go to? Asset of 800,000. That one is a capital asset. Then you have a current asset of 200, which is cash. So fixed asset, which is the machine, and the current asset, which is the cash. Two of them together is equal to your investment, which is capital of what? 1 million. I hope this is clear. I hope this is clear. Please, I need your response. So I'll make sure I'm sure I'm using a simple language for us.
Yes, sir.
It is clear, sir.
Beautiful. 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 So remember three things. Three things is showing us your what you owe, or what the company owe. When I say you, I mean the company. What the company owes, what it has collected from other people, which is liability, and the capital invested, which is equity. Now, I've explained when you use your capital invested to buy assets, then the remaining money is also still an asset, fixed asset and current asset. Two of them make up the capital. At that point, there's no liability. You're not owing anybody. But the equation says asset is equal to liability plus capital or equity. But this one I've explained to you, we didn't collect anything from anybody. So it's still the same equation. Now this one says assets equal to investment, or equal to capital or equity. We didn't collect anything from anybody. It's balanced. Now let's move it up. Let's move it up from this point, where the third leg now comes in. Remember what you owe, what you're owing others, and the capital invested. As the name suggests, the balance sheet must always balance. This is because everything in the balance in the business, everything the business owns, in bracket assets. Yes, you understand how assets starts now, must be offset against the equivalent capital and liability. Now we are bringing in the third leg, the things I collected that is not my own, that I must give back, and I must give it back as what? As more as the money equivalent. So this is the where the formula starts. So let's break it down again. The first one we did, you brought in 1 million naira. That's the example I gave us, and you bought machines of how much? Machine of 1 million, which is asset. So here, your asset and your capital balance. You didn't borrow anything from anybody. And I also said, if you bought that machine for 800,000, automatically you also have under your assets, you have what? This is a fixed asset of 800,000 and current asset of 200,000, which is your cash. So two of them make up the 1,000 equal to, of 1 million equal to the 1 million capital you invested. I hope this is clear. At this point, there's no liability. Now, we now say, if we now move it further, where you invested 1 million naira or $1,000 and you bought machine worth of 5 million. Remember, your investment is 1,000, but your machine is 5 million. So where's the remaining 4 million coming from? I need the answer to this one. So where's the remaining 4 million coming from, please? Please answer me. Where are you getting the remaining 4 million from?
Money borrowed, and it will be liability.
Beautiful.
Borrowing.
Liability. So that gives us the equation. In fact, during those days in school, the first day I heard of this equation, I was more confused than ever. But from the way I've broken it down, you understand it. The teacher didn't break it down like this. And that's where sometimes I get angry, because most of them don't have the real industry experience. So have you seen how you got it straight? So we borrowed the other 4 million, which is a liability, and we must give it back. So our asset is equal to liability and our capital, which is what your balance sheet will always show you. So if they say, what is the worth of this company? The worth of the company is 5 million. However, the company has a liability of 4 million. Can the assets pay off the liability? Yes, yes, and yes. Can the assets still pay off the liability and will still make money? Yes, because we're putting it into good use. Do you understand it? Very simple. So now say it currently has no liability. Yes, this one, because I would have moved on over this. I've thought beyond this. I just want to have understanding. So its capital is equal to asset. That is the amount of the equity the owners or shareholders have invested in the business using the accounting formula. The equation would look like this. Yes, we understand this one. Well, the teaching has gone beyond this. So let's go to where we are now in the teaching. Let's look at this. This is self-explained. The capital was 600, but the asset they bought was 1,000. So who gave the remaining one? Like they borrowed. So with this, it's easier for you. So this borrowing is not bad. I know some of us have heard the word don't owe any man, this and that. Please, there are levels to borrowing. When you borrow to eat, I'm not part of it. But when you borrow to generate good, that's borrowing for business. There are people that they've been taught not to borrow at all. It's not good for business. Borrowing is good, but you need to grow the business to an extent where it can pay its liability with ease without putting burden on you. It's a teaching for a different day. And there are so many ways you can borrow. It's not a must you must borrow money. You can borrow through goods and the rest of them. It's a different teaching. So we understand this one now. I've explained this very well. Take it up. Case studies, but let's take a number of case studies. A number of case studies. There is no magic in all this number. There is no magic here at all. There's nothing to be afraid of. All I've explained to you is just the same thing that is there. You only that we added more examples. All I've explained to you is just the same thing. So with the understanding of what I've explained, you can flow naturally with this. Fixed assets, current assets. No, I've said it before. I mentioned it. Current liability. What's the formula? Assets is equal to liability plus investment or capital. So at this one, you're looking at the assets, the liabilities, and the capital. Fixed assets or non-current assets. What are fixed assets? Those things that are tangible. Also have intangible and your investments. Example, the land you bought is a fixed asset. The cars, the investment you made, like bonds, yeah, that has long time investment. They are part of your fixed assets. Here, your asset you've acquired over time. The ones that are seen and not seen, down to even such as your logo is an asset. You know, in this part of the world, we don't see logo as an asset. We don't see all those intangibles as an asset. They are very, very big assets. If you put your logo, if you register your logo, trademark it, that's when your logo is a very big asset. Yes, a very big one. Very big one. Well, let's leave that one for now. So let's look at it. See, fixed assets are easily converted into cash and usually last longer than 1 year. They are either tangible, such as land, or intangible, such as a logo. Look at this here. Tangible assets and intangible assets. Then current assets are assets that last 1 year or less and can be easily converted into cash. Yes, or cash equivalent. And inventories are the most common current asset. Yes, inventories, your goods. Now, current liability are the amount that the company owes to individuals or organizations. Here, the money must be repaid in the current financial year. So, if you watch trade and other receivables, cash and the equivalent, they are all the ones that made up the current liability. Does it make sense now? So under the current liability, amount falling due within 1 year. So how do we know our current liability? Remember that your asset is equal to your investment plus your liability. So we had the money to take care of one area, but we'll fall short, and that falling short is what becomes the liability. So let me use, I went to buy goods. We're into, let's say we sell, we sell household items, drums, household items, let's say, which one is better, okay, we sell, what they call the bathroom solutions. These people that, the things they use in fixing the houses, bathroom, what's the right name for it? I'm looking at the where you have the likes of your shower basin and all that. What they call that business, please? Wash hand basin, bathroom, bathing, all those areas, all those things they use in bathroom, just to put the house in another white building. What they call that business, please? That's the name for that business. Can anyone remind me, please? Okay. I sell cement. Let's take cement. Since I want to get the name for that one. But that's one area that one good business that's doing well. I sell cement. Let's use cement. And that cement, under my fixed assets, I have a house. I have a house where we store it. Call it warehouse. It's a fixed asset. We paid for warehouse and all that. Under current assets, that cement, we bought the cement, but we didn't finish the payment. So that's trade and other receivables. So under current liability, that amount we must pay to cover for our cement is what you're seeing, the difference of you're seeing there. So when you add your fixed assets and current assets, you now have your what? Current what? Liability. I'm just taking time to break it for us. So you can have your fixed assets, have your current assets, at the same time have your current what? Liability. Very, very possible. Very, very possible. So I think we'll stop here for you to ask questions. Very, 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 very possible. So, but there are other, maybe by next week, I will go further into this. So for us to have a total balance of what we started from the other side. You understand? So I wouldn't want to bore us with this. So the numbers will not become too much for us. But let's go back to here. So look at these figures. This 3932.5 for 2021. Just let's focus on 2020 and 2022. Just know the figures. I want to show you what assets and liability, how they work, and assets, liability, and current capital, how they work, how we break it down. I want to show you. So please, by next week, we'll go into this other part, which is more of the liability side. You see the shareholder fund, everything, how everything balances. Do you understand how everything balances? And you'll be so surprised. This is how businesses are done. So, I don't know. Questions, contribution, your takeaway. Let's do that. Your questions, your contribution, your takeaway. Now, when I said, look at these two figures. This figure, 3932.5. Yes. Fix your eyes to it for 2021. For 2020, 3744.1. Fix your eyes to it. We'll do more of it by next week. See them here. We'll use them next week. Very, 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 very important. I'll show you what led to it and how they got to those figures. Do you understand? Now, total assets and the rest of them. We'll work around it. All right. Questions, please. Questions. Take away. Questions and take away, please. Contributions. What have you learned today? Let me use that word. We are waiting. I'll let you this class is not just for me. It's for all of us.
Good morning.
Good morning, sister.
I'm rushing a single format. What I learned is at least the three key ways you should know in your balance sheet what belongs to the company, what the company owes that they don't know. Probably maybe you give an example of those being a boy. You have goods, you don't, even though God doesn't know what is there, they can be generating money, but at the same time, keeping their own at the back. And also what you have invested. It will help you to look when you have the fixed asset and what you have bought, and also your current asset, what you have, and even liability. Another thing that I I learned is to say that borrowing, like when you borrow from, people are discouraging some persons not to borrow, but borrowing is not bad. You can borrow in as much as you can use it to generate funds. You can borrow, it's only money, you can borrow goods. Yeah, all this is my takeaway. Thank you. See you. I'm going.
Okay. Thank you so much. Thank you so much. Thank you so much. Thank you so much. Thank you. I like that. Like that. Right. So more contributions, please. More takeaway. More contributions, more takeaway. Thank you, sister. That's a beautiful one. Contributions, takeaway, please. Your contributions. For those of us that have started early, please. Pastor Okenwa, I want to hear from you. This is your area, numbers and figures. So I want to hear from you. What's your contribution, your takeaway, your advice? Just talk to us, sir. I hope you can hear us. Okay, go ahead, Dr. Ju.
Okay, I wanted to say that what we're asking about the toilets, sink.
Beautiful.
The general name is called fittings.
Fittings. Good. 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 I'm always happy when you're in class. Good. Good. Fittings. Yeah, those are into fittings. Maybe we'll use it to do example maybe some other time. Thank you so much. I appreciate it. Thank you. Wow. I need, what are you going home with? Teach us your own knowledge. Share with us, please. Share with us. I've shared mine. I want to hear from you.
Okay, another important thing I learned today is when you say that logo is an asset.
Yeah.
You know, most people might not know how important it is. Your logo is your integrity, is your assets. That's why you will mind whatever you're doing because you have that name.
Yeah.
It's also called your name, your identity.
Yeah.
It's your logo, so you can go far.
Sure.
You can destroy it with your dealings. You can also improve the quality of your logo with your dealings.
Yeah.
Thank you, sir.
Thank you so much. Thank you. And your logo is a legal entity beyond your CAC registration or company house or rest of them. Your logo is on its own, is a legal entity. That's why trademarking is very, very important. Please. Trademark it. That's where the asset starts from. Trademark it. Trademark it. Wow, that's beautiful. That's beautiful. Okay. I said earlier, please, by next week, God's grace, we will move further. Today, our focus is just on assets, fixed assets, current assets, current liability. So by next week, we'll take it up. We'll take it up and just get ready. Get ready for it and study these ones first. Study this one first. By next week, we'll get into this place. Yeah. Where you now have the net current assets. Then total assets, less current liability. Just like that. I'll break it down. Down. And you'll see. Relax. Numbers are beautiful. Numbers are what? Beautiful. With numbers, you can do a whole lot. All you just need to understand how numbers come in, how to interpret it, and you're good to go. Don't be afraid of numbers. Numbers are so sweet. Numbers are so beautiful. numbers are so good. With your numbers, you can do a whole lot. I want to say thank you to everyone. Let's meet again next week, same time, and our businesses, everything will keep getting better because of this knowledge. I know you will not, most of us, we are not chartered accountants, but we will have understanding of at least what your business worth. You can sit there and say, this is the worth of my business at any point in time, because you can separate your assets from your liability and from your capital. You can also merge it. You understand the three entities that made up your business. And when we now get into cash flow, we're now looking at inventory and the rest of them. That's the starting point. So we'll take it back from cash flow to balance sheet and P&L again. And you have, with these three understanding, we're good to go. Thank you. Thank you. Be fruitful as the week unfolds. Thank you.